A lot of people thought silver would cool off, that the move was over, that the surge we've been witnessing was just another short-lived spike. But what we are seeing right now in the global financial system does not look like a normal pause. It looks like pressure building. And if you've been watching the markets closely, you can feel it too. The signals are not coming from one place. They are coming from everywhere at once, and they are getting louder. At first, the warnings were subtle. Real yields began to stall instead of rising. The dollar stopped strengthening, even as geopolitical risks were increasing. Central banks, quietly but steadily, continued accumulating gold at a pace not seen in decades. Liquidity never truly tightened, despite all the talk about restrictive policy. These were small cracks in the narrative that inflation was defeated and stability had returned. And silver, unlike gold, began reacting faster and more violently, moving in bursts that seemed disconnected from the calm tone of official statements. When you step back and look at the real drivers, the picture becomes clearer. Global debt levels are now historically extreme, not just in one country, but across entire regions. Governments are running structural deficits that cannot be reduced without severe economic pain. That means currency creation, whether direct or indirect, becomes the only politically acceptable path. History has shown this pattern before. In the 1970s, in the late stages of Bretton Woods, and again after the 2008 financial crisis, monetary expansion combined with geopolitical tension created long cycles in precious metals. What we are witnessing today carries many of those same characteristics, but on a larger, more synchronized global scale. And the confirmation is not coming from one market or one region. You are seeing it in Asia, where physical demand for metals is consistently outpacing supply. You are seeing it in Europe, where fiscal pressure and slow growth are forcing policymakers into difficult compromises. You are seeing it in the United States, where deficits continue to expand even during periods of economic growth, a condition that historically signals structural imbalance rather than temporary stress. When multiple economic systems begin responding in similar ways, expanding liquidity, tolerating inflation, and increasing strategic reserves, that convergence is rarely accidental. But here is where the contradiction becomes impossible to ignore. Equity markets remain strong, headlines speak of resilience, and official inflation numbers suggest moderation. On the surface, everything appears stable, yet beneath that surface, inventories of physical metals are shrinking. Supply chains for industrial demand are tightening, and volatility in silver has increased to levels that normally precede larger structural moves. Markets often display this kind of split personality right before major transitions. We saw it before the dot-com collapse, before the 2008 crisis, and before the inflationary surge of 2020-2022. Calm headlines, but unstable foundations. So, what does this mean in practical terms? It means we are not looking at a simple price rally or a speculative wave. We are looking at a system adjusting to long-term imbalances, currency dilution, geopolitical fragmentation, and the revaluation of real assets in an environment where trust in monetary stability is slowly eroding. And when you put all these elements together, the broken signals, the historical parallels, the global confirmation, and the contradictions, it becomes clear that what is unfolding is not noise. It is a phase change. And phases like this, once they begin, rarely stop halfway. What is happening in the price action right now is not random, and if you are watching the screens carefully, you can feel the tension building beneath the numbers. Silver is not moving in a smooth, predictable way. It is surging, pulling back, then surging again. And that kind of behavior usually tells us something important. Markets do not move like this when they are calm. They move like this when liquidity, positioning, and psychology are all colliding at the same time. Many people look at a sudden drop after a strong rally and assume the trend is over. I have seen this reaction again and again over the years, but when you look deeper, you begin to notice that the corrections are shallow compared to the magnitude of the advance. That is not the signature of exhaustion. That is the signature of a market that is being absorbed by demand. Large players do not chase prices in straight lines. They accumulate during volatility. They allow prices to swing, shake out weaker hands, and then the trend resumes. We saw similar behavior in gold in the mid-2000s, and again in commodities during the early stages of the 2020 recovery. Right now, one of the most important forces shaping these moves is the weakening of the dollar. A declining reserve currency does not collapse overnight. It erodes gradually, almost quietly at first. But every percentage point of depreciation changes the global pricing mechanism for commodities. Metals priced in dollars begin to revalue, not only because of inflation, but because of currency translation effects across the entire international system. This is something I watched closely during previous cycles, and the pattern is repeating with remarkable consistency. At the same time, interest rate expectations are shifting in a way that is not immediately obvious in the headlines. Nominal rates may still appear high compared to the last decade, but what really matters for metals is real yield, the yield after inflation. When real yields stop rising or begin to fall, the opportunity cost of holding non-yielding assets declines, and that changes capital flows. This is not theory. This is a mechanism that has been observed repeatedly from the inflationary 1970s to the post-pandemic cycle. And right now, real yields are no longer climbing the way they were a year ago, and the market is reacting to that shift. Another piece of the puzzle is liquidity. Official narratives often speak about tightening, but when you examine global money supply, central bank balance sheets, and credit conditions, you see something different. Liquidity is still abundant on a global scale. Some regions are easing while others pause, and this divergence creates capital movements that find their way into commodities and real assets. Markets respond not to what central banks say, but to what actually happens in the financial plumbing of the system. You also need to understand the nature of silver itself. Unlike gold, silver is not only a monetary metal, it is an industrial metal deeply tied to technological infrastructure, solar energy, electronics, automotive components. These are not speculative demands, they are structural demands tied to long-term trends. When industrial demand continues to grow while above-ground inventories decline, price behavior becomes more sensitive, more explosive. That is why silver tends to move faster than gold in both directions. It has always been that way. If you go back to 2010, 2011, you will see the same pattern. Volatility first, acceleration later. And yet, despite all these signals, there is still disbelief in many corners of the market. People are anchored to past price levels, past ranges, past assumptions about what is normal. But markets do not respect what feels normal. They respond to supply, demand, liquidity, and confidence. When those forces change, price regimes change with them. I have seen entire generations of investors struggle to accept that reality because the shift does not announce itself politely. It arrives gradually, then suddenly. And by the time consensus recognizes it, the move is already well underway. So, what you are witnessing right now is not just volatility. It is the market searching for a new equilibrium in a world where currencies are under pressure, debt levels are unprecedented, and real assets are being repriced in real time. The swings, the spikes, the sharp pullbacks, these are not signs of weakness. They are signs of a system adjusting, recalibrating, and preparing for a move that is rarely smooth and never comfortable to watch in real time. If you want to understand what is really happening now, you cannot look only at price charts. Price is the last thing that moves. The real signals appear earlier, in places most people never watch. And right now, those signals are flashing at a level I have rarely seen in my years following macro markets. The tension is not theoretical anymore. It is visible in the structure of the market itself. One of the clearest warnings is coming from the physical side of the metals market. Inventories are declining in ways that are not normal for a stable environment. When warehouse stocks begin to shrink while demand continues rising, that is not just a statistic. It is a pressure point. In past cycles, from the oil shocks of the 1970s to the commodity supercycle of the 2000s, tightening physical supply was always one of the earliest signs that a market was entering a new phase. The same pattern's now unfolding again, but this time in a globalized system where supply chains are already fragile. At the same time, you are seeing unusual behavior in the relationship between paper markets and physical markets. Futures contracts and derivatives dominate pricing, but when leverage ratios grow too large compared to the available physical metal, the system becomes sensitive to stress. This is not a conspiracy theory. It is basic market structure. Any market built on high leverage depends on confidence and smooth settlement. When confidence weakens or delivery pressure rises, volatility increases sharply. We saw this in the gold market during certain periods in the late 1960s, and again in other commodities when inventories tightened faster than expected. Another signal that cannot be ignored is the behavior of the gold-silver ratio. Historically, this ratio compresses during the later stages of a precious metal cycle when silver begins to outperform. That compression is not random. It reflects a shift in investor psychology and industrial demand dynamics at the same time. When that ratio begins to move decisively, it often indicates that capital is rotating within the metals complex, not leaving it. And that is exactly the kind of internal signal experienced analysts watch carefully, because it often precedes larger moves that surprise the broader market. Then there is the matter of backwardation, a condition most people never hear about, but one that carries powerful implications. Backwardation means that immediate delivery is priced higher than future delivery, which signals urgency in the physical market. In a healthy, well-supplied commodity market, the opposite, contango, is more common. When backwardation persists, it suggests that supply today is more valuable than supply tomorrow, and that is rarely a comfortable situation for market stability. Historically, prolonged backwardation has appeared during periods of real stress, not during calm expansions. You should also pay attention to the behavior of central banks and large institutional players. These entities do not move for short-term speculation. They move for strategic reasons. When central banks accumulate gold year after year, even while public narratives focus on stability, that's a form of silent confirmation. They are not responding to headlines. They are responding to long-term structural risks, currency debasement, geopolitical fragmentation, and the possibility of a less predictable monetary order. I have watched this pattern unfold before, and when official institutions begin repositioning quietly, it usually means the underlying landscape is shifting more deeply than most people realize. But here is the contradiction that makes this moment so difficult to interpret for many observers. Financial markets on the surface still appear orderly, stock indices remain elevated, credit markets are functioning, and volatility indices are not signaling panic. To the casual observer, nothing looks broken. Yet underneath that calm surface, multiple stress indicators are flashing at once. Tight inventories, unusual spreads, aggressive central bank accumulation, and persistent demand from emerging markets. This divergence between surface calm and structural stress is one of the most reliable precursors of major market transitions. I want you to understand something important from my years of watching these cycles. Major shifts in financial systems rarely announce themselves with a single dramatic event. They build quietly through a series of small signals that most people dismiss until the cumulative effect becomes impossible to ignore. That is what makes moments like this so difficult. The evidence is visible, but it requires patience and perspective to recognize what it means. And when you step back and connect all these signals, the tightening physical market, the leverage in paper markets, the ratio movements, the backwardation, the institutional accumulation, and the growing divergence between perception and reality, you begin to see a pattern forming. It is not a short-term fluctuation. It is not a seasonal effect. It is the structure of the market itself beginning to change, slowly but unmistakably, right in front of us. Now we arrive at the question everyone eventually asks, even if they do not say it out loud. What happens next? Not tomorrow, not next week, but in the larger sense. What direction is this system moving in, and what forces are most likely to shape the outcome? Because what we are watching is not just a commodity story, it is a monetary story, a debt story, and ultimately a confidence story. The first thing you have to understand is that the global financial system is entering a phase where policy choices are becoming narrower. Governments are carrying debt burdens that would have been unimaginable a generation ago. Servicing that debt becomes more difficult when interest rates remain high, but lowering rates too quickly risks reigniting inflation. This is the trap that economists call fiscal dominance, where monetary policy becomes constrained by the realities of government financing. We have seen versions of this before. In the United States after World War II, in parts of Europe during sovereign debt crises, and in emerging markets repeatedly. The difference today is that this dynamic is unfolding simultaneously across multiple major economies. At the same time, geopolitical fragmentation is accelerating. Trade blocs are shifting, currencies are being used more selectively, and nations are increasingly concerned with securing resources and strategic reserves. Precious metals have historically played a role in periods like this, not because of speculation, but because they function outside the credit system. During the 1930s, during the collapse of Bretton Woods in the early 1970s, and even during moments of currency instability in the late 1990s, real assets were repriced as trust in financial structures weakened. History does not repeat perfectly, but the rhythms are recognizable if you have studied them long enough. But you also have to consider the risks, because markets never move in straight lines. One of the biggest potential disruptors would be a sudden surge in real yields. If inflation were to fall sharply while nominal yields remained high, the opportunity cost of holding metals would increase, and that could produce temporary corrections or periods of consolidation. Another risk would be a rapid tightening of global liquidity, something that can happen unexpectedly if financial stress forces central banks to defend currencies or stabilize banking systems. These are not theoretical possibilities. They have happened before, and they can happen again. There is also the psychological dimension, which is often underestimated. Markets are driven not only by fundamentals, but by perception. When sentiment becomes excessively optimistic, corrections become more likely, even in strong long-term trends. I have seen powerful bull markets pause or retrace sharply, simply because positioning became too crowded, and expectations ran too far ahead of reality. That is why volatility is not a contradiction to a larger trend. It is often part of the process by which markets reset and continue. Yet, even when you consider these risks, there are forces that continue to push in the opposite direction. Central banks are still accumulating reserves. Structural deficits are not shrinking. Money supply, despite temporary fluctuations, continues to expand over time. Industrial demand tied to electrification and digital infrastructure is not a short-term phenomenon. It is a multi-decade transformation. These are not cyclical forces that disappear in a quarter or two. They are structural forces that reshape entire price regimes. So what you are witnessing now is not a finished story. It is the early stage of a larger adjustment in how real assets are valued in a world of persistent inflationary pressure, high debt, and shifting geopolitical alignments. The movements may be uneven. There will be pauses, corrections, moments when the narrative seems to change overnight. But when you step back and look at the larger arc, the direction of pressure becomes difficult to ignore. And this is the point I want you to remember, especially if you have been watching markets for years, or if you are just beginning to pay attention. Major transitions in financial history rarely feel dramatic in real time. They feel confusing, contradictory, and uncertain. Only later do they appear obvious in hindsight. What we are living through now has many of those same characteristics. The quiet buildup of imbalances, the gradual shift in policy constraints, the revaluation of tangible assets, and the slow erosion of assumptions that once seemed permanent. That is why the real signal is not a single price level or a single headline. The real signal is the convergence of forces, monetary, fiscal, geopolitical, and psychological, all pointing in the same direction. And when you see that convergence, when you recognize it clearly, you begin to understand that the move we are witnessing is not just another cycle. It is part of a deeper transformation that is still unfolding right in front of us.